You have some extra money, and you know you should be investing it, but every time you try to figure out where to start, you end up with 17 tabs open and 0 decisions made. I've been there. So in this video, I'm going to cut through all of it. By the end, you'll know exactly what to invest in, how much, and how to place your very first trade, even if you're starting from 0. Here's the roadmap. Why investing is not optional, what to actually invest in, how much to start with, and a live walkthrough of buying a stock, plus strategy, holding periods, and taxes. Feel free to jump around, but let's get into it. Here's a simple truth. Money sitting still is money losing value. There's a force called inflation quietly eroding what your dollars can buy every single year. That's $7 for a cheeseburger from last year, it's $8 now. Same burger, more money. That gap, that's inflation. And if your savings are just sitting in a bank account earning next to nothing, inflation is slowly winning. Investing is how you fight back. When you invest, two things happen. First, you own a piece of the companies you invest in. When those companies grow, more products sold, more revenue, more market share, your investment grows with them. Second, and this is the one that changes how you think about money forever, compound interest. Here's a real example. Say you invest $1,000 a month and earn an average 8% annual return. After 10 years, you've invested $120,000. That's it. The real number, about 4 years after that, you're approaching $1 million. You're adding $5,000 a month to something you never actually touched. That's not magic, that's math. Your returns start earning their own returns, and the effect snowballs. Albert Einstein reportedly called compound interest the eighth wonder of the world, and honestly, the numbers back it up. The most common beginner mistake is opening up a brokerage app, looking at which stocks performed well recently, and buying those. That sounds logical. It's not. Nokia controlled 30% of the global phone market in 2010. By 2020, that share was less than 1%. Same story with companies like General Motors, DuPont, Enron. They were the titans of their era. Today's biggest companies barely resemble that list. The only overlap between the top companies of 1999 and now is Microsoft. Past performance does not predict the future. Picking individual stocks as a beginner is like putting every egg in one basket and then balancing it on your head while running. So what's the smarter move? Index funds. What's an index fund? An index is just a list, like the S&P 500, which is the 500 largest U.S. companies. An index fund simply holds all of those companies at once. So when you buy one share of an S&P 500 index fund, you automatically own a tiny slice of 500 companies. The benefit is instant diversification. If one company tanks, the other 499 absorb the blow. Warren Buffett has said in multiple shareholder letters that index funds are the best way for most people to invest. If it's good enough for him, it's good enough for us. One thing to watch, index funds charge fees called expense ratios. A fund with a 1% expense ratio on $10,000 costs you $100 annually, automatically deducted from your returns. The good news is there are excellent funds with expense ratios between 0.03 and 0.5%. I'll give you 3 specific ones worth researching in a moment. Before you invest a single dollar, run through this 2-question checklist. Do you have high-interest TET above 7%? If yes, pay that off first. Here's why. The stock market averages roughly 10% annually, but if your credit card charges 20%, that 10% return is a guaranteed 20% loss. You can't beat that in the market. Plug the leak before you fill the tank. Second question, do you have 3 to 6 months of expenses saved as an emergency fund? Investing money you might need soon is dangerous. A car breaks down, a medical bill arrives. Without a cushion, you'd be forced to sell investments, possibly at a loss, just to cover it. Once you can check both boxes, you're ready. As for how much, there's no minimum. You can start with $1. But here's the reality. The more you invest, the more you make. A 10% return on $10 is $1. On $500, it's $50.
On 45,000, it's 4,500 just for not panicking. The rule, only invest money you won't need for at least 3 to 5 years. The stock market will go up and down in the short term. Time is what smooths it out. I'm using Robinhood for this walkthrough, but the steps are nearly identical on Fidelity, Schwab, or any other brokerage. Open your brokerage app and connect your bank account. Transfer whatever amount you're comfortable with, even $50 to start. Search for the stock or fund you want. Type in APPL for Apple. You'll see 2 order types. Market order, buys immediately at the current price. Simple and fast, good for beginners. Limit order, you set the price you want to pay. The trade only executes if the stock hits that price. More control, but no guarantee it fills. Select quantity, confirm the order, and you're done. You now own a piece of Apple. Selling works exactly the same, just tap Sell instead. But honestly, my advice is to not touch it. Which brings us to the most important part of this whole video. You invested in the S&P 500 in September 2007 at $154 per share. Feels great. Then 2008 hits, the financial crisis, and your investment drops to $70, more than half gone. Every instinct tells you to sell. Cut your losses. Get out. But here's what actually happened if you held. By 2013, you were back to even. By 2015, you'd doubled. By 2019, you'd quadrupled. The market recovered. Today, that same share is worth $500 just for not panicking. This is the core lesson of long-term investing. The market goes down. It always has. It also recovers. It always has. A study that backtested 10 years of market data found that missing just the 10 best trading days, which happened right after a crash, reduced returns by 46%. A $100,000 investment that stayed in became $325,000. One that kept selling after bad news became $163,000. Same time period. The difference is behavior. Now, 3 index funds worth researching before your first investment. SPY or IVV, both track the S&P 500, the 500 largest U.S. companies. Expense ratio around 0.03 to 0.09%. Fees are basically nothing. VUG, Vanguard Growth ETF, focuses on high-growth companies. Expense ratio around 0.04%. Higher risk, higher potential reward. Better for younger investors with longer horizons. SCHD, Schwab U.S. Equity Dividend ETF. Companies that pay you cash dividends. Expense ratio around 0.06%. Great for income-focused or more conservative investors. On taxes, profits from selling investments are called capital gains. Short-term, meaning you held less than a year, get taxed as regular income. That could be 30% or more depending on your bracket. Long-term, meaning you held more than a year, get taxed at 0, 15, or 20% depending on your income. The difference is massive. Sell before a year and you'll pay your regular income tax rate. Hold longer and you could literally pay 0%. One more thing, if you sell at a loss, you can use that loss to offset other gains, meaning you can legally reduce your tax bill. Worth knowing, worth remembering. Here's everything you need to start investing. Pay off high-interest debt first, build an emergency fund, then choose low-cost index funds. Think long-term, never panic, and the best time to start is now. If you want to know exactly what to do with each paycheck each month to make all of this possible, I've got a video on that. I'll see you there.